This past week, markets have been trying to price in an unusually messy mix of macro risks. You had a major geopolitical shock centered on Iran. Crude futures briefly spiked towards that $110 range. I think it stopped somewhere around $107. It did give some of that move back, but cross-asset portfolios have been putting out a meaningful chunk of their year-to-date gains, and it's just been a few sessions. At the same time, crypto has been trading in a very different regime than it did a year ago. Derivatives positionings, ETF flows, on-chain activity, they are all telling slightly different stories. So on today's episode, we are going to unpack what this Iran-driven price action actually means for our macro risk, how Ethereum's institutional story is evolving, why AI agents may be a bigger structural theme for crypto than most people realize, and how we are seeing the further institutionalization of this asset class with things like crypto-backed mortgages and even 401k plans. So let's get started. Welcome back to the Crypto Markets Podcast. I'm Dave Duong, Global Head of Research at Coinbase. And as always, I'm joined by my co-host, Colin Basco, who works with me in research. On the show, we're focused on macro trends, market structure, the flows that are shaping crypto performance. And we've got a great episode today. I don't always say that, just some of the time. So you know that I mean it. But here's how we're going to break things down today. Macro in Iran, we're going to talk about how this recent move in energy and cross-asset volatility is signaling how crypto has behaved more resiliently around these shocks. We're then going to talk about AI agents and how we think AI agents on-chain paired with tokenization, stablecoins, all these other major themes in crypto could be a defining trend and theme in this cycle. We're going to pivot then to Ethereum, talk about how ETH's institutional adoption is changing in a world of spot staking ETFs, derivatives, growing on-chain usage, and maybe how the L1, L2 narrative has actually changed without people noticing. We're then going to end with institutionalization and what it means in practice when we talk about crypto intersecting with crypto-backed mortgages, retirement accounts, all these other broader household balance sheets that people have. So let's kind of get started. Colin, on the macro backdrop, let's kick it off. Walk us through how you saw the Iran headlines this weekend.
Yeah, so I think this weekend was where I actually started to get worried just based off of price action. Right now, I'm seeing crude oil staying pretty elevated because the market still is respecting that supply risk. And we're seeing equities violently bouncing around pretty much every time we see some small de-escalation headline. But I don't really think that that's sticking. And I think that kind of makes sense just given how mixed the headlines are. A lot of people are still confused what exactly is going on. On one side, you have signals that the next few days could be decisive and that there's at least some willingness to end the campaign. But on the other side, you have like things like tanker disruption, you have a clear escalation risk, and there's no obvious resolution path yet. So I think right now, the market is not trading a peace outcome. And it's also not trading a full-blown worst case scenario either. The big problem for me from a price perspective is that once oil gets high enough, the story just stops being about just war and it becomes more of an economic problem with inflation rates and growth expectations coming down. And so what worried me over the weekend was primarily the breakout above 100. So right there, you saw it rejected several times from 100. And then finally, over this weekend on hyperliquidity starting to break out. And then you saw the confirmation earlier this week as well. And it's continuing to hold above 100, which is problematic because I think the probability of it retesting 120 is increasing now, just from a purely price perspective. And from what you're seeing in terms of equities, it does appear that they are trading respecting that macro damage that high oil can do. You're already seeing a ton of assets across the space, not only in like semiconductors, but you're seeing grid infrastructure, a bunch of different tech equities, all, giving up gains in the markets over the past couple of days, which is, I think, basically people are pricing in that expectation of higher oil prices going to continue to have those downstream effects in terms of inflation. And the real problem is that high oil is going to be is essentially tightening the financial conditions that makes the Fed's job a lot harder. And once that starts to happen, then I think you see a much more difficult environment for broader equities because investors will have to start pricing in fewer cuts and they'll have to reward a hike risk higher. So there's a higher probability of higher rates for a longer period of time. And I think if that disruption continues to take place, then you have like the stagflationary effect taking place where there's a possibility of the job displacement from AI to be hitting us on one side, and then also the inflationary risk to hit us on the other side, in which case that would put the Fed into a pretty bad position. So overall, I think this breakout above 100 is not particularly good in the long run for risk assets, but interested to hear what you have to say for that, David. Not a great environment overall, in my opinion.
No, I think that we are in a very different macro environment than the one we started the year with. Like we came into the year, at least I did, very positive that we were going to get backdoor stimulus via being like the Supreme Court decision around IEEPA tariffs, which happened. This was just a month ago, but Supreme Court came in, said those tariffs were illegal. I thought that would unlock $180 billion worth of capital going back into the economy. I thought that the Federal Reserve would come in with rate cuts, and those two things alone would put us in a great regime for risk assets, like more generally, but crypto more specifically, given what we suffered in the events of 10/10. But now we're here, and I mean, everything's dominated by geopolitical risk right now. I feel like there's very little you can do if you're a long-only investor. This is why we've seen cash positions rise so sharply over the course of just like 2-3 weeks. Like I think, the last survey that Bank of America did said that cash positions from global fund managers was somewhere around 4.3%. And that was one of the fastest rises they've seen in years. But it's no surprise. I mean, if you're a multi-asset, cross-asset portfolio, like you really don't have a ton of options here. I think that, systematic portfolios are probably doing pretty well. But it was interesting because we didn't have Fed Chair Powell come out yesterday. He was speaking at Harvard, I believe. And he actually sounded pretty dovish, like when it came to oil prices. And as you kind of mentioned, I mean, this is the big concern. Like this is an energy-led kind of inflation shock. But he kind of framed it as this is going to be a one-off, and the Fed has no purview to actually, or no ability really, to kind of handle one-off shocks like that. They're there to deal with structural kind of developments as far as inflation higher or lower is concerned. So he actually came off kind of like, rate cuts are still entirely within the picture, which I was kind of surprised by. I thought he'd take a more kind of cautious stance, but maybe he's also trying to react to where this market is. Markets just wrote it off. And I think that was huge to me because markets kind of like repriced slightly in terms of where, policy expectations were, because we've pretty much taken out all of those cuts for 2026. They kind of reintroduced some of those now, although the probability is still pretty low. But then by the afternoon, we just undid all of that and markets were weaker. And we've been seeing this pattern, I think, as far as equity markets are concerned, not really in crypto, but equity markets are seeing this pattern of like Monday you come in, they markets kind of strengthen, they recover, then they drop by the end of the week as people kind of close off positions before Friday because they don't want to hold that risk over the weekend, and then it kind of repeats again. And this is what we've seen over the last 3-4 weeks. But now we're kind of like speed running that pattern. Crypto, meanwhile, like it's been downright resilient. Yes, we're kind of down here and like below the sub like 70 region, but we have this chart up here where we look at this on a risk adjusted basis, and actually crypto is moved only maybe one standard deviation, a little bit less sometimes, a little bit more, but the rest of the asset classes are down by like 3-4 standard deviations. So we're in a different place, and I think that a lot of investors are noticing this. I don't know, like Colin, like I know you're more of a systematic kind of trader when it comes to these kind of things. Any thoughts on this pattern we're seeing?
Yeah. So I think just from a cross asset perspective, from a systematic purely approach, just based off of price action alone, you're seeing logical breakouts in where you would expect. So for example, when oil was able to break out of that tight $100 range, $100 was like a very key level because it had broken out and had retested that level several times before retracing significantly. It retraced all the way down to some 90 several times after retesting 100. But for the first time, for some reason, market participants are now willing to buy above 100, which is a bad sign. So that's where I'm thinking that something has structurally changed potentially in the actual dynamic of the war. And that's where I'm getting worried, because now at the same time that oil broke out above $100, that key level, you saw a bunch of different equities as well breaking down out of key levels that they had held for a long period of time. And you're seeing the S&P trading at key levels that it hadn't retested for several months. And now that kind of trade, when it happens concurrently, I think is a pretty big telegraph to the rest of the market that people are not pricing in a good resolution to the war right now. Now, obviously, that can change, which is why systematic traders will change their bias very relatively frequently based off of what happens in price. And I think that it is still possible that something will happen. Some new development will happen. Trump could tweet something and there could be a resolution that could happen on the horizon. But as of now, it does not appear that people are pricing in that expectation. You're also seeing gold starting to rally, have a more of a convincing breakout for the first time since it dumped significantly. So I think overall, just like the cross asset signal from a bunch of different markets is not bullish for risk assets in the short term. At least that's my interpretation.
Yeah, I think it's challenging because, if we had seen a quick wrap up to this conflict in the Middle East, I would have said, okay, we can kind of bounce back pretty quickly, and I could see risk assets actually doing very well. Instead, I mean, we have no idea what the time frame is going to look like. I think there are some people who suggest Trump initially thought of this as a 6-week kind of conflict. Instead, this military operation has extended into we're still within that time frame, but if it goes beyond those 6 weeks, and I talked to some experts just last week, like Friday, for example, some who had worked in the Trump administration, and they were suggesting that this could last until like June or July, although I don't think anyone really knows what that's going to look like. But if it lasts till June and July, then the potential for a global recession becomes a much bigger risk. That's going to dampen the risk sentiment across the board. And I don't think that crypto is going to be immune from that. Maybe, again, from a relative perspective, it can kind of outperform some of the other risk assets like equities and other things. But I mean, ultimately, I don't think that anything comes out unscathed there. So it's a pretty dangerous picture if we don't see a much faster wrap up to these things.
I also think there's like another possibility here that I don't think people should ignore, which is the possibility that even if fighting cools down, oil can still stay sticky if physical shortages and shipping disruptions take time to normalize. So even if there is a de-escalation headline, that doesn't necessarily mean that automatically we're going to get a full macro reset, because the damage to the physical supply chain can keep that oil problem alive longer than people expect, which means that the downstream effects on inflation could also take some time to play out. So I think that's where we're getting into some weird sticky territory where you're seeing a lot of volatility in markets because people don't exactly know how to price in this kind of delay, because it really hasn't happened to this level of magnitude before. So it seems like people are just throwing out numbers without any solid backing in terms of being able to model it out properly, which is where you get into even more risky situations, which also makes sense why people are de-risking out of a lot of these growth equities.
Well, that's also the crazy thing about the implications of energy, because, I mean, I think there's the initial shock, and then there's a medium, longer term kind of effect in these things. And I think that we've kind of reconciled that the initial shock is that oil prices higher. That means manufacturing of goods goes higher as well, like diesel costs. We've been through this on this podcast before. But it's actually not clear cut when we're talking about the medium to longer term. Like, is it inflationary? Is it deflationary? Is it disinflationary? It's actually all of those things, which is the weird thing when it comes to energy prices. So that makes it even harder when we're talking about how central banks are going to respond to this issue. And honestly, I don't think that anyone's got a good read on this. At least I definitely don't. So anyway, that's the macro framing. But there's another theme that has been important in recent months. It's kind of been pushed to the side because of this conflict in Iran, but there's AI. And I feel like AI is sitting at the intersection of all of these macro forces, as well as the evolution of the crypto market structure. So we've just published a paper on this. If you are a Coinbase One subscriber, you should have this in your email right now. But, one of the core pillars of the current crypto cycle is that, a lot of people have talked about tokenization, stablecoins. AI agents is a big one. And beyond AI agents, agentic commerce is also growing. And this could potentially be a foundational building block for crypto in the years to come. Of course, AI agents can mean a lot of different things to a lot of different people. So we kind of got to define what this means in a market context. But Colin, you were the main author on this paper. Where do you see the first real adoption for AI agents and really how to monetize this? Is it going to be through portfolio rebalancing, treasury management, market making? Like, what's going to be the big gaining factor for each of those things?
Yeah. And even before we get to there, let's take like a step back in terms of why or do people even care? Like what exactly is causing AI to resurge so significantly in headlines recently? Because there was a period where AI and AI tokens and different crypto tokens that were AI related were not performing particularly well. And then all of a sudden you saw them starting to rally in the past couple of months. And so I think the key thing here is that a couple of weeks ago, NVIDIA held their huge annual GTC conference, which essentially is one of the biggest important industry events for understanding where exactly artificial intelligence is heading. And for me, I think the main takeaway was that the conversation has very clearly shifted towards inference, reasoning, and persistent agents. In other words, the market is moving away from just training bigger models and different LLMs and towards how exactly should they figure out whether or not autonomous software is going to work in like the real world in creating actual economic output. So I think the right place to start from that is that once you frame it that way, the crypto angle becomes a lot easier to understand. Because if AI is moving towards persistent agents that can essentially act on their own, like individual people, then those agents are eventually going to need a way to handle those assets and make payments, to be able to hire people, to coordinate with other agents and settle value. And I think that's where the crypto lens becomes a lot more economically relevant. So the real topic here is what kind of infrastructure those autonomous software agents are going to need if they're going to function like real economic actors. And the way to think about that from an agentic AI perspective is to frame them as essentially a new class of economic participant. These systems already in production, they can already reason, they can plan, they can write code, they can call tools, they can coordinate workflows. I think OpenClaw was like one of the greatest examples of this. But they still are incomplete if they cannot transact. So while an agent may be able to build an application or run an analysis, they still cannot independently buy cloud compute or pay for the data or compensate someone else and settle revenue splits and things like that unless someone manually steps in. So that's like the real last mile problem of AI. Now, the more important question is, how do you solve that? How does crypto solve that? And how do you even make money from an investor lens? I think that's probably the most interesting question. And I think from that perspective, there's a couple of different ways to frame it. I think the main opportunity here is the financial and coordination layer that autonomous software is going to need to be able to actually transact and create value at scale. So, for example, if an agent is going to buy a service and then hire someone else and then escrow those funds and settle those obligations, then they actually need to have things like wallets and payments and settlement rails in different reputation systems and service discovery infrastructure for that actually to work in the first place. And to me, that's the most defensible part of the stack, is those foundational rails. So the first place that I think that value is likely to accrue is in those toll roads, and not necessarily like the flashiest application layers, but in things like stablecoins, the settlement layers, the wallet infrastructure, machine native payment standards, those kinds of things that are able to actually monetize recurring machine activity. And I think the key word there is recurring, in the fact that that is essentially the ground layer for how agents in this new economy are going to be able to transact at scale. So I think from that perspective, something called X402 is useful. And I think what makes X402 important is that it essentially turns API requests into machine readable payment flows. And that's something that Coinbase has been investing heavily into. So essentially what this means is that it allows for machine commerce to actually work in practice. So for example, I think one of the things that a lot of people probably already understand about agents is that from an agentic perspective, a lot of people can make thousands of low value calls on crypto because crypto is so cheap in terms of transaction fees, whereas like the card and subscription model is like 2.9% per transaction plus additional fees. But here, in terms of X402, you can have like tons of transactions happen on these different networks that offer very like cheap transaction fees, and they're able to do so at a much cheaper net fee overall. So here, what you'll see on this chart, if you're watching on YouTube, is Base essentially has over triple that of Solana's in terms of transaction volumes for X402 payments. And so clearly, in terms of like the transaction layer, I think one of the big winners here is like the Base ecosystem. So I guess like in terms of that perspective, David, I guess, do you have any thoughts there in terms of agentic AI capacity in terms of these new layers that are occurring? I know Tempo just launched. Right now, it's pretty small, in my opinion. I don't think it's necessarily a huge competitor to X402 yet. MPP is a relatively small percentage of total agentic transactions. But I guess, like, David, how do you see this evolving?
Yeah. I mean, first of all, I like the way you put that because, if you are one of these AI agents, you simply can't use TradFi things like credit card or bank account. And that's why things like X402 and these newer micropayment standards, I think, are going to be meaningful. And already, like, I don't think we're the only ones who are thinking about this new agentic commerce kind of world. You already seeing headlines like, Meta making the purchase for Moltbook and creating social networks for these kinds of things. There's also like ERC 8004 standard on Ethereum that is enabling identity. It's a tool for identity for these AI agents. But you're absolutely right. Like if we divide the investment opportunity itself, three layers that we kind of broadly think about it in. Like number one would be the foundational rails, and that would include kind of what things you mentioned already, like wallets, stablecoins. And trying to capture those opportunities. It might not necessarily be in token form first, but it could in certain different ways. But then you also have the coordination layer. So if one AI agent needs to like hire another AI agent for a job, like you got to think, how do systems like X402 Bazaar or Virtual's agent commerce protocol like allow them to find each other, and they need to negotiate the job. A human cannot be involved in those kinds of things. So I think that's probably, for me anyway, like the most interesting part of where like we can actually look at the potential like performance kind of indicators where like you can actually look for tokens and kind of get involved in that. But in these permissionless agent economies, one thing that I think that we are kind of being nervous about, not nervous isn't the right word, but, like things that I think people need to think about is there could still be this potential for rampant fraud because there's still civil abuse, just like anything else. If anything, it might be faster because you can have malicious actors spinning up thousands of these kind of like low quality agents. And that's really kind of where the integrity layer kind of comes in. And I think tools like ERC 8004 are important. But, like Colin, I don't know, like I would love to kind of get your opinions on this. How do you get like incentive systems built around like tokens to kind of create these verifiable trust models for these machines?
Yeah, so I think Tau is an interesting one here. So I think the incentive problem is huge because you don't want that civil abuse. You don't want people just spinning up a ton of different actors and just making up nonsense on the blockchain. So in my view, I think BitTensor, and one of the reasons why it's rallying so high, so hotly right now, is because BitTensor it's increasingly less of an abstract token incentive system, and it's more of a real decentralized intelligence network that actually incentivizes good action. And the important change here is that the system is directly tying more value, more directly to capital allocation and subnet competition. And I think one of the craziest examples of this was Covenant 7B. And it obviously got a ton of headline news. Essentially, for people who don't know what it is, it's a very powerful case study in what can be achieved through incentivized decentralized training. It's a model that was trained on over 72 billion parameters by over 20 people using over 1 trillion tokens. That's a pretty insane accomplishment to do fully decentralized. So I think from that perspective, if decentralized intelligence becomes a real category, I think BitTensor gives you real exposure to that stack. And it's a good example of where you can actually use incentivized sort of token incentives to actually get more real development that actually can result in real tangible world value. So I think when I take a step back here in terms of like the cleanest way to organize this whole theme of AI in general, I think we have three questions, which is who moves the value, who routes the value, and then who proves the value was actually created. And that's where you get the foundational rails, the coordination rails, and then the integrity rails. And so I think just in general, in terms of framing AI for crypto, I think those would be the clear lens for how to analyze a token and where it fits within the AI crypto ecosystem. But overall, I just think that crypto is uniquely situated for an agentic AI system, just given the fact that, as we mentioned, the foundational rails in particularly are well suited for crypto versus in TradFi, you get much higher costs, a lot of friction, and there's a much less it's much less central. It's way more centralized. It's not decentralized enough, in my perspective, to be able to function at scale for agentic payments, as well as there's like a lot of regulatory red tape, et cetera. So in terms of innovation speed as well, I think crypto is just much more suited for being foundational rails for agentic AI.
So I like that. And you kind of touched on this, but there's that trade-off between these higher risk, higher upside tokens versus those foundational rails, which I guess, the way you described it, it's more like durable toll roads that monetize recurring machine activity. Could you kind of just be more specific though? Like, what are the tokens that map to each of those layers, like virtuals for coordination, for example, or Venice or VVV for tokenized inference? Like, what should people be looking out for?
Yeah. So I think virtual, it sits closer to the service discovery, agent creation, and agent to agent commerce component. So if the machine economy continues to grow, and we expect that to grow significantly, then more of that activity is going to be routed through tokenized marketplaces and coordination layers. And then I think virtual becomes more of a public market expression of that stack. But I'd still be careful with that one. It's a little bit higher beta piece of the theme than the foundational rails. It'll sit more, in my opinion, into that second layer, that coordination layer, in terms of being able to build on that value. So that one I think is a little bit higher beta. I think Venice, as you mentioned, that one's kind of is like one of the sort of different value expressions in terms of being able to establish in tokenized inference itself. So that one is a lot more, I think, idiosyncratic in the fact that it requires the Venice ecosystem to grow sort of on its own, in terms of being able to have like high demand for Venice's APIs and actual token inference on that ecosystem itself. So that one's probably a little bit further downstream than like BitTensor or virtual, and would be in more of the application layer, in my opinion.
Yeah, and I think there's a lot here. We could spend a lot more time on this because, if you believe that a meaningful share of future financial transactions are going to be machine to machine, which we do, then I think blockchains are going to become the natural settlement rails for these flows. And of course, that has direct implications for demand for block space. I think that's going to impact the role of ETH, other gas tokens, probably the structure of fees, MEV. And that kind of brings us to our next topic, because we've been kind of discussing Ethereum for a while, but I think it's kind of hitting this institutional moment. Things have changed. Like last week, we spoke about how now like BlackRock has a staking ETH ETF. But there's this kind of persistent narrative that Ethereum L1, the mainnet, has kind of been, affected by its growth, its scaling solution, which were the L2s. And, we've dug back into this, and we've pretty much said, like, actually, if we unpack this, it's not as much as what people think. And actually, I've been on this theme for a while. Like I said this a year ago as well, that I didn't think that L2s were quite as extractive as people believed. But let's kind of like dig into this now. Like, Colin, like, what's your overarching thesis on that L1, L2 narrative?
Yeah, so I think the ecosystem does not just seem to be expanding outward anymore, which I think it increasingly is starting to look like it is recentering back around Ethereum L1. And we put out a lot of data to support this. And I think that distinction matters a lot, because if we get the case where activity, liquidity, imbalances are tilting back toward that base layer, then Ethereum is starting to look less like a passive settlement infrastructure, and it's more like an actual economic center of the ecosystem again, in which case the value for the Ethereum token itself should theoretically go up. So I think the key reason here that this is happening is pretty intuitive. So originally, rollups were winning on price in terms of their transaction fees were significantly lower than Ethereum back in the day. I don't know if you, David, you ever traded on these like decentralized networks, but Ethereum was kind of insane in terms of buying some of these new launches, like these new tokens. Sometimes you'd be paying upwards of $100 just to be able to buy the token. So I think that was the case where you got those rollups. They were offering meaningfully cheaper execution than mainnet, so it made sense that activity would start to go towards those different rollups. But once Ethereum fees came down significantly enough, then I think the trade-off changes. So for example, if users are no longer saving that much by leaving mainnet, then why would you bother to do that in the first place? And there's an actual cost to doing that, right? There's a cost of fragmentation. So once you have to sort of bridge assets and split liquidity across venues and move collateral around, then you're giving up some of that composability that made Ethereum valuable in the first place. Like, I don't think it makes as much sense for these high value actors to support that liquidity fragmentation if the fees are no longer an advantage. And I think, in my opinion, that's what's kind of what is happening. Like, a lot of those advantages are coming back to Ethereum L1 in terms of being able to attract, some higher value activity, like in terms of stablecoins and total tokenized asset, real world asset values. A lot of that is still primarily going to be on Ethereum. So I think in terms of just activity migration and where liquidity is migrating, a lot of that is back to Ethereum. And I think what makes this story a little bit more interesting is that I don't think this is necessarily a temporary flow story, because we have the Glamsterdam upgrade on the horizon. And I think the reason why that's important is because it compounds on what I'm already saying. And it suggests that Ethereum is trying to make the base layer itself a lot more execution capable and not just a passive settlement hub. And I think that was also part of what Vitalik was writing about in his write-up, that like different L2s need to differentiate themselves more than just transaction fees, because now Ethereum also has lower transaction fees after a series of upgrades. So if it does become the case that the base layer is already getting, handling activity more efficiently, then like what exactly is the pitch to take that activity off of Ethereum? And I think that's where you're seeing a lot of the data, like stablecoin supply, tokenized asset values, all of that just, recentralizing onto Ethereum. And I think that's what is essentially kind of just one of the main benefits of Ethereum going forward. But also kind of, if you were to take the opposite case in terms of L2s, if you look at their token price performance all the way, pulling it back all the way to October 10th, you're seeing not a single major L2 token has been able to outperform Ethereum price-wise. So it seems like the market is also already pricing in this narrative as well. So overall, I think Ethereum is potentially going to be a big winner from that perspective. But even then, from a fundamental perspective, while Ethereum might look better positioned, I still think from like a price perspective, everything is still just going to follow Bitcoin anyways. So if Bitcoin is not able to sustain a bull trend, then I think the case for Ethereum being able to idiosyncratically break out against Bitcoin is relatively limited. And even if it does, I would expect that to be sold off relatively quickly. I think in general, whenever you see beta, like high beta assets, idiosyncratically break out against the dominant asset, generally those flows get sold off pretty quickly whenever the dominant asset is in a bear trend. And you can see that also in Ethereum versus the beta to Ethereum. So these L2 tokens, you can see like these momentary bursts of outperformance where these different individual altcoin L2s are breaking out idiosyncratically against Ethereum. But look how quickly they get sold off. And I think that's just like a generic property you'll see happening in crypto play out all over the place, and in every market cycle too.
Yeah, I'm curious if like that's going to remain the case. And I absolutely don't disagree with you. I think right now, in order for the rest of the crypto complex to do better, to recover from the events of 1010 and other things, you kind of need to see Bitcoin as a precondition doing, rallying. And, with still Bitcoin represents 67% of this market, or at least last I checked. I'm not sure if it's like maybe a little bit lower, the Bitcoin dominance, but, like at the same time, like once upon a time, we talked about, the flippening in crypto where Ethereum market cap would overtake Bitcoin. Obviously, that's never happened. But as you kind of suggested, more and more stablecoin supply, real world assets, they're using Ethereum L1 to actually transact. And if more of that higher quality capital is sitting on Ethereum, I mean, could there be one day where the, economics of Ethereum, like the tokenomics of like ETH itself, get, divorced from Bitcoin? That's entirely a possibility. I don't think it's the case right now. It's one of those far off things, definitely within the realm of possibility in my mind. But something you kind of like you talked about, which I don't want to gloss over because I think it's important. Glamsterdam has a roadmap that I think is going to be important for Ethereum. It's going to continue pushing the scaling, kind of like blobs and other stuff as well. But there's at least two key EIPs that I think are worth kind of talking about. One is EIP 7928, which is the block level access list, and the other is EIP 7732. I mean, we don't have to go too deep into it, but Colin, can you just kind of introduce what those two EIPs are and kind of talk about why they're relevant for this upgrade?
Yeah, so I think there's two major EIPs. So there was 7928 and then there was 7732. And while I won't bore you with the details and the nitty gritty in terms of what they actually upgrade, I think the main key takeaway here is just building on Ethereum's ability to be able to scale effectively. So I think generally taking a step back, what people have generally viewed Ethereum L1 versus L2, the common metaphor is is it a highway where every L2 essentially adds another lane to the L1 highway? And before, when you needed those extra lanes to be able to let traffic through, in an orderly manner and not cause congestion on the L1, now with these different, now essentially what's happening is with all these upgrades to L1, the highway itself is becoming bigger. So the need for extra lanes is decreasing. So essentially what these two different EIPs do is they're increasing the execution capability of Ethereum for one. And for the second one, it's making it essentially more quickly and more efficiently able to process transactions. So the ability for the people to say that L2s are able to transact more quickly or process these different transactions more quickly than in the Ethereum L1, that case becomes weaker because now with these upgrades, theoretically, the L1 itself should be higher capacity, more scalable, and be able to efficiently process the transactions much more quickly and efficiently. So I think from just that, in terms of that narrative, it just really supports the idea that from a structural perspective, Ethereum L1 is going to be able to do essentially what the original use case of L1s or L2s originally were for, which was to expand Ethereum's ability to handle a ton of transactions and to handle them quickly and efficiently.
Yeah, that's great. And I think that there's more on Ethereum that we can talk about. Please definitely look at our weekly report for more data on that. But to close out today's episode, let's talk about institutionalization. Because this is kind of a broad theme that we've been seeing incrementally happen inside of crypto. Some people have shied away from it because there's do we really want institutions in the space? But now we're talking about crypto-backed mortgages, the fact that you can hold crypto in a 401k. And I mean, it's a meaningful liquidity unlock, I think, from the crypto space. But once upon a time, the whole DeFi complex kind of came out of the idea that we actually couldn't use crypto as collateral for all these things because the banks and other institutions wouldn't allow us to do so. Well, that's no longer the case. So when people hear institutional crypto adoption, it's not just about what are the DATs doing, what are hedge funds doing, are they doing the basis trade? Those are obviously important themes. But I think that when we're thinking about using crypto within core financial products, that is going to be a big unlock. So the stuff that households actually want to use, mortgages, retirement accounts. I mean, Colin, obviously with the headlines that we've gotten over the last week, what do you think is the most realistic kind of expectations we can have with crypto-backed mortgages and the fact that crypto is now going to be allowed in 401ks?
Yeah, unfortunately, from a price perspective, I don't think it's been relatively well interpreted by the market. We haven't really seen an breakout in terms of Bitcoin. But then again, crypto has been holding out relatively well compared to equities based off of the oil shock. So maybe some of these regulatory developments are helping on the margin. But I think just long term, it's an interesting development for me. I think just in terms of investing money in my own 401k, I think it's a pretty interesting prospect to be able to allocate capital towards crypto in either a diversified manner from equities. I think there have been pretty compelling evidence that crypto is able to expose additional diversification benefits for just investing in crypto alongside equity and bonds. So I think from that perspective, it's a plus. For crypto-backed mortgages, as a real estate investor, I'm interested to see how this plays out. I don't know exactly how this will work out, but definitely interested to see how it works with a volatile asset such as crypto. I don't know, David. Do you know if it's easier to do a crypto-backed mortgage with USDC versus Bitcoin? Because I guess USDC is a lot easier, but using Bitcoin as a down payment, how does that work?
Yeah, it's a good question because borrowers anyway can only pledge Bitcoin or USDC as collateral for the down payment on a loan. And I should say that the headline is that Fannie Mae is going to now accept these crypto-backed mortgages for the first time, and this is I think a new product come from Better Homes and Finance Company. Coinbase as well is a partner in this, so I should make that very clear. But I think that structure is still pretty important because, these are still going to be Fannie Mae eligible mortgages. So, within like a pretty tight like underwriting framework, like this pretty much kind of looks like your traditional loan. But how it's going to be priced, how like frequently that Bitcoin, because, if Bitcoin moves, does that affect the way that the kind of collateral sits and no one wants to get kind of taken out of their position or taken out of their mortgage because you got to live somewhere if, things kind of move against you. So, yeah, it's a good question. I think that, this isn't entirely new because, there are like loans written on equities and other things as well. So I'm sure there's a haircut that's going to be like needed to kind of have this kind of stuff. But, this was all based on a directive from the Federal Housing Finance Agency, I think last year. So probably they have some plan in place. I'm going to be looking for those details because honestly, I don't know them right now. But I think it's going to be interesting. And the other thing was like the big one coming from the Department of Labor that now people will be allowed to have this in their 401k. But I think for all of this stuff, I think we're still going to need to see regulatory clarity coming from Congress. So ultimately, I think a lot of this hinges on getting the Clarity Act passed, which we talked about, I think, in the last episode. But I know we went through a lot of topics. This has been kind of a longer show than most, but I feel like it was important to kind of recap. We talked about the Iran-driven price action. We talked about AI agents. We talked about Ethereum. We also talked about how, institutionalization of crypto is really starting to touch the core for household finance. So not just what's happening for a lot of the large institutions that listen to the show, but if you want to dig deeper into the data, the frameworks that we mentioned today, definitely look at our latest research. We also, by the way, I didn't mention this, we just published our guide to crypto markets. So if you are new to the space and just trying to navigate, well, how do I even trade Bitcoin and ETH? And like, what are the products I can use from trading spot, ETFs to options to derivatives like perps, as well as, traditional finance, traditional futures. Please see our guide to crypto markets. It's on our website right now. It's anyone who doesn't know, it's on go to Google or whatever, like search engine and type in Coinbase institutional research. It should take you there. Otherwise, though, thanks for listening to the Coinbase Markets podcast. If you found this helpful, please consider subscribing, leaving a review, sharing it with a friend or a colleague who's trying to navigate the space. And we will be back next time with more on how crypto and global markets are evolving. Thanks a lot.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third-party investment strategies or digital assets or any website or content related thereto.